Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everyone. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. I hope you are having a fantastic day today. I'm doing pretty good. Kind of excited to share today's show with you folks and just going to talk to you folks about some things that, some things that are on my mind. And this show is part of a series about how to potentially make up your investment losses after a downturn and the stock market. And a lot of times people get out and they just don't know when to get back in. And because they don't know when to get back in, the timing or the strategy of why to get back in, they either get back in too early, way too early, or they get back in too late. And I mean way too late. And so I want to talk to you about timing the market without a crystal ball. And I think one of the craziest myths is the thing about like stock market timing, like how to time the market. If you look at all the searches out there and things like that, I honestly believe there's no such thing as timing the stock market. I believe there's no such thing. I believe only in timing your entry point and your exit point of certain positions, not the stock market. And everywhere I go, when people find out what I do, the number one thing they ask me is they say, Harold, how's the market today? And I tell them, I don't know. I don't really care about the market. I only care about my positions. And that's just how I have to see it. And so since we're going to be talking about investments, all investments do carry some level of risk of loss. Past performance is no indicator of future results. And before you invest any money, make sure you're investing according to a well-balanced, comprehensive financial plan that has all of your goals and your dreams in mind. And also you have to understand your risk tolerance. You have to do your due diligence and understand what it is that you're getting yourself involved in, because this could be a major win for you or it can be a major disaster. So are you ready? 1, 2, 3, let's get it. So timing the market without a crystal ball. I'm going to change that to timing certain positions without a crystal ball. And there's a couple of different ways that if you've gotten out, you're scared to get back in, here's how we have to look at this. Whether or not you are early to the party or to the position or late to the position depends on your plan or your strategy. Your plan and your strategy should dictate all of this. Okay, so you've gotten out, you have certain goals, you have certain dreams. Let's talk about being early to the party. So the first thing I want to look at today is I'm going to go back to one of my favorite positions. And I wouldn't say it's a favorite position because I don't fall in love with any stock. I would say they're one of my favorite potentials that's going to drive my portfolio to the moon, I believe. Those are my thoughts on this position. And I'll tell you why. And I've slowly been building up large amounts of options in Amazon and in Microsoft and in Palantir. I already have a ton of positions in NVIDIA already. I've already been there. I've slowly been adding to those. Now, I'm not telling you to go buy options on these things because I have no idea what your situation looks like. I have no idea what your risk tolerance looks like. Okay. So right now, Amazon has a high target price in the next 12 months of $287 a share. This thing changes a little bit from time to time. The low forecast is $195 a share. And the median forecast over the next 12 months is $246.70. That's a 31.35% upside from here. Now, I'm going to pause here for a second, and I'm going to segue into something that I don't hear a lot of people talking about. And why are people so negative and why are people so pessimistic right now about the future outlook of the stock market? And I can tell you this and it's just, let me be careful how I say this. If I go to the AAII Investor Sentiment Survey, okay, and this survey comes out every single week. It's conducted at 12:01 a.m. Thursday until Wednesday at 11:59 p.m. It comes out like every week. And you can log in and you can vote, but you have to become a member and you have to vote. Okay, so what direction do all members feel the stock market will be in the next 6 months? Check this out. 21.9% say the market will be bullish. 22.5% say the market will be neutral, and 55.6% say the market will be bearish and it'll be negative. And my question to these people that are answering the survey, again, how or why? And when you hear people in the media, they say, oh, the market has a very negative outlook. The question is, why? Are you only interested in talking points, or are you interested in telling the truth? Because what you are saying is hurting a lot of people. And this is why it's so important that you be working with someone, because we can help you to wash all of that away, put your headphones on, and enjoy your music, enjoy your vacation, enjoy spending time with your grandkids, enjoy remodeling your house, enjoy buying a brand new car, enjoy helping your kids pay for college tuition or private school tuition. You know why? Because we got the headphones on, we got a strategy in place, we know when to get in, and we know exactly what our plan is calling for. And it's not calling for bearishness. And to me, this is a perfect time for me to add and layer into my positions, because when everybody's negative, I'm a contrarian. I'm going to be positive. I'm going to be very positive. Okay. And also, I'm not going to get into the political aspect of it, but it does have something to do with who's in power. So if more people answer the survey that didn't vote for the current president, of course, they're going to be a little negative because they're not going to give him any credit because they don't like him. Same thing with the last president. If you ask people who didn't vote for him, they thought he was going to kill the stock market. And I heard some of that, like, Harold, Biden's just going to F everything up. So I'm selling all my stuff and I'm going to run and hide. I'm like, why? Does your plan call for a divesting of all your positions because the guy that got into office, you didn't vote for him? You can't do that. And this is why a lot of people miss out, because of bias. And I'm going to tell you, smart trades have no bias. They're only interested in, when you make a smart trade, guess what? I believe you will be richly rewarded because you made a smart trade. So let me ask you this. Back to Amazon. There's 47 ratings on Amazon, 46 buy, 1 hold. These are some of the top analysts in the country. We have access to the software. We can see exactly what they're talking about. Okay. And a lot of them have pretty good track records. You can just kind of look at it. So we're not just believing what we hear on CNBC or wherever or whatever headline it is. We're actually looking at the data. So Amazon has a strong buy. They're trading at $187.70 a share right now, well below the low forecast of $195. Now, what happened to Amazon? Well, Amazon got beat up, and they got beaten up really bad due to what? What was the catalyst that drove Amazon down? The talk about tariffs. Harold, tariffs is going to tear everything apart. I mean, I don't think so. I think that's a lot of hyperbole. I'm sure it's going to hurt a certain segment of certain markets, yes. But that's not what we're here for today, okay? I'm here to talk to you about when and how to get back into positions in the market. So over the last 3 months, guess what happened to Amazon? Because of all the technical sell-offs and all of the negative news media, Amazon went down to a 26.26 on the relative strength index. And the relative strength index is what you look at to determine whether or not a position is oversold or overbought. The higher the number, the position could be overbought. The lower the number, the position could be oversold. Now, will Amazon be around 100 years from now? Maybe, but I think they will be. Will they be around 20 years from now? I think so. How long do you actually need Amazon to be around for? You only need them around if you're there in your portfolio to get you to your ultimate goal. And then you can buy another company after that. You can always rotate your portfolio. McDonald's has been around for darn near forever. But are we jumping in and out of McDonald's? The answer probably is no. McDonald's is a long-term trade, and I treat those stocks as like kind of like cash or placeholders in your position in turbulent times, because if I got to buy them, you got to put money to work somewhere. And then when when the coast is clear, then guess what? I'm going to start to put money to work. Okay. So I used to be an air traffic controller. And what happens in the air is when the plane experiences turbulence, the pilot says, he comes on the intercom, and he says, hey, buckle up, everybody. We're about to hit some turbulence, and I'm going to either drop a few thousand feet or I'm going to climb a few thousand feet. I'm going to try to find some clear air. And that's what we're doing in turbulent times in the market. We're either rotating out of some positions into other positions. We don't stop flying midair. We don't do that. We keep flying the plane. So Amazon was oversold. Again, to me, when the market is oversold, what I do is I tend to sell out of the stocks and I buy the options on the stocks, on some of them anyway. Now, when the market got down to a 3 on the fear and greed index on the CNN, that to me, that was the day to start selling stocks and buying options, because that was the bottom. And that's when you get in options, is when they crash the stock, you get in on the options, but your person has to understand that, and they have to be constantly watching this thing every single day. And we are investing our clients according to a plan and a strategy. That's why we can get in and out. And sometimes we're going to be a little early to the party. So when they broke the gauge, we got in and it went back up. The very next week, they crashed everything down again over some tweets. I'm telling you, the market dropped 1,000 points over some tweets that really had no validity, no bearing on the market. And it was all like algorithm selling and media driven. And that was horrible. That freaked out everybody. And it was the president saying he wanted the Fed chair gone. Anyway, that again too was another time to layer in and add more into the position. So we didn't go whole hog and start buying as much as we possibly could with all the cash. We layered in every week. We dinked, we dunked, we dinked, we dunked. Buy some here, buy some there, buy 1 contract, buy 2 contracts, buy 3 contracts today, buy 4 contracts, because it was a couple of $1,000. And when our clients have millions of dollars in their portfolios, $3,000 or $4,000 being early to a trade is not going to kill them. But if we're late to the trade, once that position has gone up $10, $15 a share, that's when you're too late. Okay, now, if you're going to buy the position for the short term, yes, it's okay to be a little early. It's okay to do that. All right. But if you're going to hold it for the long term, you just kind of layer it in. Like if you're just buying stocks, you just kind of layer in dollar cost average and dollar DCA. And it don't matter when the party starts and the party ends, because you're doing this for the long term and you're willing to ride through all the turbulence and things like that because you have your long-term strategy. So Amazon was oversold. The catalyst was the tariffs. Okay. The talk of the tariffs, the fear of the tariffs. That's the catalyst to the downside. Well, Amazon is eventually going to recover, right? Well, what is the catalyst for helping Amazon recover? Simply tariff deals and talk of tariffs going away or reaching some kind of agreement. That is a catalyst for every single stock in the market. Well, when is this going to happen? I don't know. It can't last forever. I mean, it can't, because the guy only has 4 years in office, then he's gone. Now, it can happen for 3 years. So we don't think that's going to happen either, because there's way too much pressure. But all of this fear, has it done anything to the fundamentals of Amazon over the last year? And I have a chart that I use to kind of talk about this. Well, over the last 2 years, there's something called earnings before taxes and depreciation, EBITDA. You can look these terms up. So earnings before taxes and depreciation, that line is up, straight up to the right. Free cash flow. Amazon's free cash flow has taken a little bit of a dip, but it was straight up to the right until they started investing heavily into AI. And this, they call it CapEx. And so that kind of drove the position down. What about the return on the capital invested? Boom, that's straight up to the right. What about their long-term debt? That's coming down like a rock. These guys are flush with cash. And what about the revenue per share? Up, up, up. The fundamentals of this company have not changed. It is phenomenal. So therefore, we can do either a scoop and score on these trades if you're in an IRA, which means we put a short-term trade, short-dated option in the portfolio, say for 6 months. That's a scoop and score. Or we can do a long-term trade on it for about 2 years with an option that expires in 2027. Or we can do even a longer-term trade where we buy the stock and we hold it. And this is what helps you get back in the market. We're taking small, calculated steps to help ease back in and to help reduce the fear. Because some people will never just get all back in at one time. And we've seen a lot of spikes in searches on how to time the market. We see a lot of spike in searches on how to buy back in after a crash. And I'm going to simply say it like this as I close today's conversation. I'm going to say it like this. Start small, win big, book a call. Start small, potentially win big, book a call at brightfg.com. And then learn my timing strategy. Or you can check out the next episode for why your coworkers are the worst advisors ever. And I have a pretty interesting story I want to tell about that, but I'll share it with you folks in the next episode. So start small, potentially win big, book a call at brightfg.com. And until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.